This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Risk-off sentiment returns as investors await concrete signs of trade deals. Tariff fears begin to bite corporate earnings with Ford and Mattel pulling full-year guidance. Traders expecting little respite for the battered US dollar in Asia markets today. Taiwan regulators meeting with insurers to assess the currency's biggest surge since the 1980s. And Chinese markets set to reopen after the holidays, with state media reporting a jump in travel across the Labor Day break.
And that strength in the Taiwan dollar, Haidi, really a lot to do with what's happening on the other side of that trade with the U.S. dollar, right? This idea of sell America gaining momentum. We're seeing the Bloomberg dollar index declining by the most since the inception of that index in about 20 years year to date. We're talking about a 7% loss. A lot to do with this fading idea of U.S. exceptionalism. That question was put forward to Secretary Scott Bessent. This is what he had to say.
America is the Schelling point of global finance. We have the world's reserve currency and the deepest and most liquid capital markets and the strongest property rights. For these reasons, the United States is the premier destination for international capital, and the administration's goal is to make it even more appealing for investors like you.
We also heard from Apollo Global Management CEO Mark Rowing saying that the administration's goals when it comes to the tariffs are not necessarily incorrect, but certainly what we're seeing now is causing a whole lot of risk both to US markets, to sentiment, as well as the broader economy. Take a listen.
I see us moving from what was hyper-exceptionalism to merely exceptional, because I don't think there are good alternatives to the US today, but that can change over time.
Take a look at how U.S. futures are trading early in the Asia session after we saw stocks fall by the first time in about 10 sessions. We're talking about halting the longest rally in about 20 years. We had that data showing a pickup in growth when it comes to service providers. And despite the more positive data, we had that pressure on U.S. equities, just risk assets in general. Do keep an eye on the two-year yield because it's been gaining ground for the last 3 sessions. The expectation right now that the Fed will hold rates steady. It will be really wait-and-see mode as all of these trade tensions and tariffs unfold around the world. We had a little bit of a pop when it comes to oil prices. Of course, we had that downside pressure given the OPEC Plus agreement to release more supply to the global markets. But when it comes to the dollar, as I mentioned earlier, it was really that pressure that sent the Bloomberg dollar index down about 7% year to date. On the other side of that trade, we have the Taiwan dollar leading the gains. Take a look at how we're setting up in Asian assets. Still, Japan and South Korea away on holidays, but we'll be watching what Taiwan will do with the Taiwanese dollar surging about 5% at one point, given the dollar weakness on the other side of that trade and the central bank in Taiwan allowing for more flexibility. When it comes to the offshore yuan, we'll continue to watch the surge on that currency as well. We're talking about the highest levels for the yuan in about 6 months. The Japanese yen also thin trading today, but we have seen a little bit more strength. Nikkei futures right now not doing much as ASX 200 futures are under pressure right now, Haidi.
Asian currencies under pressure in the other direction, right? As you mentioned, we're focusing on Taiwan, where the central bank governor urging market commentators to stop speculating about the foreign exchange market, saying it can destabilize the market, and the impact on the economy as well is not to be underplayed. Let's bring Garfield Reynolds, who leads our Markets Live Asia coverage. And Taiwan's a standout, right? The strongest since February 2023. But a lot of these APAC currencies are at levels at least at year-to-date highs or, last year's highs as well. What do you make of this?
Well, Heidi, the most extraordinary thing about this is how rapidly it happened in Taiwan. I was looking at it yesterday, and if you crunch the numbers to compare where the Taiwan dollar is relative to its recent statistical averages, this is the most extreme set of gains that has ever occurred for the Taiwan dollar, because it's gone so far out of the range of where it was. And it's the sort of move that usually takes place amid a major crisis. There were a bunch of currencies for which this happened when they fell in COVID, or you have some sort of the currency peg gives way. The Swiss franc, when it rallied like crazy after the Swiss National Bank got rid of the cap on the Swiss franc against the euro. So these are truly extraordinary moves, and that's having an impact, across the Asian space, and it's helping to emphasize the extreme distaste for the US dollar that you could already see in a lot of currencies. The euro, the yen, the Swiss franc, not only have they gained a lot this year, but currency traders are continuing to expect they will gain further. It's costing them much less to insure against gains in those currencies against the dollar than it is to insure against gains by the dollar, because people don't see much of a need to worry about the dollar gaining when you've got a US administration that is happy to see a weaker dollar. You have the impact of the trade wars, which has people anticipating weaker US growth, complete with potential for fresh inflationary impulses, which isn't seen as leading to significant tightening from the Fed, but it also means you're not seeing as strong an expectation as you might have for them to cut. So you've got these extreme concerns about the US economy within the currency markets, and the currency markets are very unforgiving places. You can't. You don't have that same sort of innate optimism there as you do in equities markets. Equities, the expectation is there will be profits, there will be growth, and that will feed into ever higher stock prices. You don't get that in currencies because it's far more of a relative. Where's the US dollar going to go against the euro? So that's my takeaway. That the Asian FX can keep climbing. And so can everything else against the US dollar in the current climate.
Does that include the yuan as well? Because, of course, mainland markets reopened today after holidays. We had the offshore yuan already rallying. Could we see that upside as well for the yuan, despite the fact that the PBOC, of course, has that trading band?
Well, I think there's a very strong chance that the PBOC will set a fix that will help to put a stop to some of the more extreme gains in the yuan that we saw over the last couple of days when the Taiwan dollar was surging and mainland China was away on holidays. If they allow for this appreciation to continue in the Chinese yuan, I think that would be taken, rightly or wrongly, by markets as a step towards some sort of trade peace. One of the things that the Trump administration and other US administrations for that matter have been critical of at times is countries who try to keep their currencies unjustifiably weak against the US dollar because that makes their exports more competitive when they sell to the US. So that's something that might be seen in that light, whether accurately or not. But I am mostly expecting the PBOC will seek to calm things down. It's never very happy if traders start to think that the yuan in one direction or the other is one directional, that everybody can pile in, as it were, and expect that the Chinese government will allow the yuan to keep rising or to keep falling. So they're likely to put up a couple of stop signs, I would think, and they are almost certainly more capable of standing in the way of this sort of move than Taiwan's central bank has been.
Bloomberg's Garfield Reynolds there with the latest on all of these currency moves, especially the rally in Asian currencies that could challenge Asia's economies, of course, very trade dependent. Over in the United States, Citi CEO Jane Fraser says conflicting economic signals, including strong payrolls and weak consumer sentiment, are complicating the Fed's job.
It's very hard for the Fed right now because of this disconnect between hard data and soft data, and the hard data holding up while the sentiment data is clearly impacted. And until there is more clarity, it will be hard to know.
This comes as the Trump administration continues to tease trade deals that could shift market sentiment. Again, let's bring in Bloomberg's global economy correspondent, Vanda Insights. And of course, we continue to hear from President Trump that trade deals could be coming as soon as this week. But in the meantime, when it comes to economic data, how is the Federal Reserve expected to assess everything that we've got so far when it makes its decision this week?
Well, we are getting a lot of signals from administration officials, as you mentioned, Shery, that deals are coming. Treasury Secretary Scott Bessent was out today with that speech making a powerful case for America as a destination, and he made the point that within that speech that trade deals are imminent. Commerce Secretary Howard Lutnick making similar points on TV, and of course President Trump last night on Air Force One also. We don't yet know details, but all of it's kind of adding to mood music that those deals can't come soon enough, really, because the economy is sending mixed signals. There is data suggesting things are holding up okay. The ISM indicator today, better than expected, remaining in positive territory. But of course, we had manufacturing data last week signaling that sector remains under pressure. The backdrop to it all being a labour market that remains strong. So we have the Fed on Wednesday. It's the first time they've met since the middle of March, and that was well before Liberation Day. Back then, they downgraded their growth forecast, but it kind of said it was too soon to tell where the economy is going to go. Well, we have had a lot of new information since then, a lot of new developments. We won't get new growth forecasts from the Fed on Wednesday, but I think a lot of people will be listening out for Fed Chair Powell's comments on just exactly how he thinks the economy is going to fare under all of this. He's obviously in a very tight political spot. He's getting a lot of pressure from the White House, a lot of criticism from the White House, but at the same time, even though he doesn't want to wade into politics, I think there will be a lot of scrutiny on him to come out and say what he thinks is going to happen on the economic side of all of this, at least. So no change in the policy rate expected Wednesday, but a lot of focus in terms of what direction, what messaging, what tone the Fed will deliver in terms of where they think things will be say 6 odd months from now.
And things could be quite ugly 6 odd months from now, right? Because you're already starting to see the pass-through when it comes to prices. But also, how is sort of the sentiment side doing in terms of both businesses and households being able to make decisions with any degree of confidence?
I think there's obviously a lot of confusion out there, a lot of disruption to business operations, whether they are big business or small business. We saw today alone Ford coming out with a warning on its guidance. Mattel, of course, making a similar point about its own outlook. That's not unusual among listed companies. We have small and medium-sized businesses complaining of disruption to sourcing their goods, the cost of their goods, the price that they're going to have to pass on to their customers, and of course the impact that will have on demand. So that's happening. But of course, not just defenders of the White House trade policy, the data itself isn't yet falling through the floor per se. As I mentioned earlier, the jobs data is holding up okay. The GDP data last week was a negative headline, but underneath that, signs of strength among consumers. But I think the real question, Haidi, to your point, is where this all will go in the months ahead. Once these big tariffs on Chinese goods start to kick in, which are kicking in more or less now, really, on goods landing at the ports, that will flow through to consumers, that will flow through to prices and demand. And of course, as the months go by, more pressure comes on inventory, more pressure comes on companies trying to source these goods. It's expected there will start to be a broader impact on beyond sentiment and moving into the world of retail spending and the like. So lots of question marks over where this goes. The White House says it will drive investment in production. A lot of skeptics saying there's going to be significant damage to the economy before we get to that point.
Bloomberg's global economy correspondent Vanda Insights there. Coming up on the Asia trade, the outlook for sinking global oil prices. We get the view from Vanda Insights. We'll also be talking market strategy with UBS Global Wealth Management, plus hear what Australian businesses want from the re-elected Albanese government. The Chamber of Commerce and Industry CEO Andrew McKellar will be joining us. Much more ahead. This is Bloomberg. Apollo Global Management CEO Mark Rowan there is backing President Trump's economic goals through tariffs, but he tells Bloomberg the US also risks slowing the economy if it doesn't resolve the uncertainty around trade policy.
What the administration wants to do, in my opinion, is not wrong. We are the freest trading country in the world and have been since the end of World War II. It is not clear to me that we have to be, or that we should allow allies and strategic competitors to inhibit our access to their markets. We can take issue with how it's being done and the uncertainty it's creating, but the president and the administration start with a really strong hand. Low unemployment, good job growth, massive capital investment over the last 4 years and continuing in the US. So now is actually a good time, but we have uncertainty. And in the face of uncertainty, people do not make new investments, they do not hire, they do not make moves. We likely will cause 2 quarters of negative growth if we in fact don't resolve the uncertainty. So until we have resolution of what the rules of the game are, it's going to be slow.
A lot of people talk about the potential for a recession, but little are people talking about the severity that could exist in the potential for a recession.
Look, now we're talking about forecasts and projections. In our firm, when we were raising rates 300 and 400 basis points, we talked about a non-recession recession, which is a correction in asset prices, but not necessarily in labor. We kind of see the same thing happening again. It's not to say we won't have some fallout and some adjustment, but we're starting from a place of 4% unemployment, good job growth. We are building infrastructure, we're building semiconductor plants, we're absorbing massive amounts of foreign direct investment. Like it or not, we're building Inflation Reduction Act factories. And now the president is channeling capital from around the world to come back here. Some days I wake up and worry about capital. Most days I wake up and worry about where will we get all the people to do this.
Apollo Global Management CEO Mark Rowan speaking with Bloomberg's Shonali Basak at the Milken Conference. And the latest from the corporate front, Ford shares fell in extended trading after it suspended full-year guidance and warned the Trump auto tariffs will take a toll on profit. The company says the levies would cost it about $1.5 billion in adjusted earnings before interest and taxes. Ford cites several factors in withdrawing its earlier forecast, including potential supply chain disruption tied to the trade war. Mattel also citing the Trump tariffs as it withdrew its forecast for return to sales growth this year. The company says it's pausing its full-year guidance due to the volatile macroeconomic situation. Mattel makes nearly 40% of its products in China, which Trump has hit with a 145% tariff. Palantir has raised its full-year revenue forecast as quarterly sales beat analyst estimates, describing rising demand for AI software as a ravenous whirlwind. It expects sales to be about $3.9 billion this year, a 36% increase. But the stock fell in late trading as the outlook fell short of Wall Street's lofty expectations. Coming up next, we'll discuss what traders are anticipating as markets reopen in China and Hong Kong after being closed since Thursday. This is Bloomberg.
Take a look at how we're tracking when it comes to China futures. Of course, Chinese markets coming back from that May-Day holiday, and has been so eventful when it comes particularly to FX trading in this part of the world, right? Both China as well as Hong Kong markets set to reopen. And of course, we're expecting to see perhaps some movements when it comes to retail, hospitality, travel and tourism related stocks there as well. For Hong Kong, we're also watching the currency as well, with the HKMA selling a record amount of currency to defend that dollar peg. Well, China's May-Day holiday seeing a surge in travel, according to state media, giving us a glimpse into consumption appetite that has no signs of a breakthrough in the trade war. Let's bring our China correspondent, Min Lo. So the preliminary numbers, what sort of picture does that paint?
Yeah, so we don't have the final data from the Chinese ministries yet, but state media has been quoting some preliminary data which shows that travel had remained pretty robust during the May-Day holiday, citing about an 8% increase when it comes to rail travel and about 6.3% increase on year when it comes to catering and retail. But when I look at the box office numbers, though, that paints a very different picture. Actually, box office numbers really slumping, showing about half of the numbers that we saw in last year's this May Day holiday. So it's a little bit of a mixed picture here. I think let's wait for the final data to give us a sense of the per capita spending, because it could be that maybe more people are traveling, but perhaps not spending so much. We are also seeing, according to Trip.com, preliminary data showing that spending in some of these smaller cities are outpacing, or rather the growth in spending is outpacing that in the bigger cities. And again, is this a reflection of changing travel trends, people preferring to go to less crowded, more experiential sort of experiences, or is it because people are choosing to go to places where spending costs will be lower, because obviously in the smaller cities it's not going to be as expensive as the big tier 1 cities. We also have a very strong data from inbound travelers, spending up about 170%. State media saying that this is because of the visa-free policy for many countries, as well as the tax return policy for tourists as well. So at least the policy from the Chinese government has already generated some returns, and this is the first glimpse that we have of China's consumption appetite post-Liberation Day. So again, a mixed picture, but I guess we have to see the coming data in the month of May, what it tells us about the overall picture of the health of the economy after those tariffs kicked in.
Mainland markets also took a breather from all of the market gyrations globally, not to mention the trade headlines. What are we expecting the open to look like today?
Yeah, there's a lot of catching up to do, because market was closed since Thursday, and that was when the Chinese authorities announced that they were going to evaluate the possibility of trade talk. That hasn't been really reflected in Chinese markets. We saw on Friday Hong Kong markets rallying on the back of that, so we might see a bit of catching up. Overnight, the Golden Dragon, I think there was not much in the way of drivers or news flow. We're seeing that trading sideways. Of course, we have Scott Bessent on CNBC actually saying we could see progress, substantial progress, he said, in China-US trade talks in the coming weeks. But again, very mixed signals here, given that Trump yesterday is saying that Chinese and US officials have been talking about very different things. So keep a close eye on that. Of course, we're watching the yuan very closely, given the big moves, the big rally in the Taiwanese dollar. We have seen the yuan actually lagging behind some of its other Asian peers, including the Japanese yen and the Taiwanese dollar, both of which had risen about 9% against the US dollar so far this year. So our MLive team is saying that there is more room for the Chinese yuan to strengthen as well. So keep an eye on the FIX today. The PBOC has been strengthening the FIX for 5 sessions up to the end of last week. So the mandate for the PBOC, it looks like, is shifted away from managing that moderate decline to actually preventing excessive strength in the yuan.
Bloomberg China correspondent Min Lo will also be watching the Hong Kong dollar, because Hong Kong Monetary Authority have been really defending that peg and selling a record amount of Hong Kong dollars at this point. But take a look at how the Japanese yen is trading at the moment, pretty range bound. But of course, on the other side of that trade is a weakness in the US dollar. Japanese market still closed today, Korean market still closed today. And as Min just mentioned, the offshore yuan around the highest levels that we have seen in about 6 months. The euro not doing much. 113 is your level, but remember the weakness of the dollar sending all other currencies on the other side of that trade to that record highs, the Taiwan dollar jumping the most since the 1980s. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at the commodities complex, starting with gold. Of course, it has just been such a rush for the precious metals. At the moment, we're seeing pretty flat trading. We did see an advance in the past couple of sessions. Trade war risk still at play here, as we also await that Fed decision later this week as well. This hope, or the sort of suggestion that we've heard from President Trump, that we could get some trade deals this week. No imminent accord, though, being struck with China at the moment. That is still weighing on sentiment. We're also watching iron ore. We did see also a bit of an edging up when it comes to some of these industrial metals prices as well, after President Trump signalled potentially a softer positioning when it comes to tariffs on China. Some of these levies, of course, he acknowledged were so high that the two countries had essentially stopped doing business. But of course, iron ore has been quite hard hit, along with some of the other industrial metals, by these steep tariffs. A lot of concerns about the weakness in demand out of China as well. And also watching oil, we're seeing a little bit of a recovery when it comes to New York crude, but of course still the weight of that OPEC plus supply supply surge and the demand side issues as well at play here. Let's bring our next guest, who says that crude prices may stabilise if a deal with a major trading partner is announced this week by the US. With us now is Vanda Hari, who's the founder of Vanda Insights Vandana Hari. Great to have you with us. What magnitude of trade deal do you think we would need to see, and how would that play out, given that, you know, the OPEC Plus supply return has happened at a pretty difficult time for the demand side for this market?
Yeah, good morning, Haidi. So it does look like the only thing that could put a bottom under prices now, or even lift them a little bit, would be some sort of a rapprochement starting to happen on the trade deals front. Now, of course, I think overnight we heard Trump saying a few deals may be announced as early as this week. And from reports, it seems like it could be some of the major countries, major trading partners, including India, perhaps Japan, South Korea. But really what the markets are waiting for, and I would say this is especially true for oil, is what the US and China are going to go do together. As you were just mentioning, the trade between the two countries is almost seized up. But, you know, for oil, you're talking about the world's two largest, not just two largest economies, but the two largest oil consumers. And China, yes, its growth has been slowing down, but it has still been a major driver of oil demand growth. So looks like what happens between the US and China is still a bit up in the air. So I won't hold my breath for oil starting to climb anytime soon.
Were you surprised that OPEC Plus decided to go now?
Not really. I think there were plenty of hints through last week, and I'm not sure if that was deliberate on the part of some of the OPEC Plus ministers to, kind of prepare the market for the shock. But there were reports that this was going to be the outcome, that they decide to yet another acceleration, putting nearly 3 times as much oil as they had initially planned back into the market in June, about 411,000 barrels per day. I think what has spooked the markets more than that decision is reports coming out after the ministers' meeting on Saturday that Saudi Arabia has put the quota busters, Kazakhstan, Iraq, Russia, on notice that if they don't improve the compensatory mechanism, the compliance with compensatory cuts, then all of the oil could be brought back before the end of this year, instead of staggered over 18 months. I think that would probably spell quite a bit of glut in the market.
It's been interesting that it's been really framed like trying to punish these cheating cartel members, but how much of it could also be about a fundamental shift when it comes to Saudi oil policy at this point? Yeah, so it's two sides of the coin, to my mind. One could look at it as punishing or even warning, trying to get them back in line. But it could also be simply placating the other members, the remaining 5 members of that 8-member group who have been disciplined about their quotas and who are perhaps now not too comfortable, unhappy even, that the three of their group members are overproducing, are not adhering to their compensatory cuts either, because now it's really a race to the market, back to market share, even more than what would have been the case in normal times, because oil demand is going down. The markets, especially in Asia, are going to be shrinking a little bit. And these countries, especially the 8 amongst the OPEC Plus that have been holding back 2.2 million barrels per day since January of last year, have given up a lot of their market share. And while they have given it up to the non-OPEC Plus members, there's quite a bit of competition internally as well, because amongst these 8, the 5 that have been more disciplined, you could argue have given up more of the market than the 3 that haven't been. So there's quite a bit of this internal dynamics playing out as well. About those non-OPEC competitors, how much is this to do potentially with U.S. shale producers? Of course, we know that historically Saudi Arabia has fought back against them and flooded the markets back in 2014 and 2016 with oil. Yeah, so as U.S. as the
biggest oil producer and growing, not as phenomenally as was the case during the shale boom, but still growing to successive record highs above 13 million barrels per day. It will always remain a competitor, and especially one that is not given to restraining its production, except under responding to market economics. It will always be a competitor. I don't think, however, that OPEC Plus decisions are being guided by this competition with the U.S. It's pretty clear, in fact, since late last year, but especially so in the last few weeks. Overnight, we had Diamondback Energy, which is a pure play major shale producer in the Permian, saying that they are going to be cutting back on drilling, fracking, and that's the story across the shale sector. So, shale is going to sort of come down, moderate quite a bit in its growth because of lower oil prices, current or even below 70 oil prices. So I don't think OPEC Plus particularly needs to drive that sector down with its policies. I think it's more to do with maintaining OPEC Plus internal cohesion. And at this point, really, they are out of chips. It's hard for OPEC Plus, especially just 8 members, to be struggling against this major contraction that we are seeing, wave of economic downturn and demand downturn.
Vandana Hari, always good to see you, founder of Vanda Insights, with her take on oil prices right now. And these are some of the other stories that we're following at the moment. Bloomberg has learned that India is proposing 0 tariffs on steel, auto components, and pharmaceuticals in its trade negotiations with the U.S. Sources say the condition would be applied on a reciprocal basis and only up to a certain quantity of imports. The two nations are prioritizing certain sectors to strike a deal before the end of President Trump's 90-day pause on tit-for-tat tariffs. Pakistan is accusing India of almost entirely stopping the flow of water across the border between the two neighbors as tensions rise. A Pakistani official says water flow has been throttled almost 90% since Sunday, potentially cutting supply to farms. India suspended a water treaty last month after gunmen killed 26 people in Kashmir. Pakistan denies Indian claims of official involvement in that attack. The Trump administration has blocked Harvard University from new federal research grants. The move could affect over $1 billion annually, and the Ivy League school would need to enter a negotiation with the administration to resume eligibility. Harvard has come under fire from President Trump and his allies, who accuse it and other elite universities of ideological bias. We have more ahead on the Asia Trade. This is Bloomberg.
Time for morning calls ahead of the Asia trading day, and Wells Fargo Securities' Christopher Harvey isn't budging from its bullish projection that the S&P 500 index will end the year above 7,000. That's a 24% increase from its current level. Harvey told Bloomberg that he thinks the time of peak uncertainty has passed. Bank of America says credit markets can expect support from the White House that will limit the extent of corporate bond spreads widening this year. The bank expects investment-grade spreads should stay range-bound between 90 and 130 basis points. Its strategists say in a note that peak tariff risks are likely behind us. We're taking a look at that close to 5% surge on the Taiwan dollar on Monday, forcing the country's central bank to tamp down on speculation on forex markets. Take a look at that 1 month move as well, 10% over 2 days there. We're seeing government Yan Qinglong saying that market chatter is partially responsible for the local currency's biggest 2-day gain in over 3 decades. For more, let's bring in our FX and rates reporter, Michael Wilson. And we're seeing to various degrees this impact a lot of APAC currencies, but Taiwan is really the standout.
It certainly is, and with good reason. It's been grinding higher for years, as the US dollar has done so, and I'm talking about the spot rate there. And all at once you've had this rush for the door, where unhedged US dollar longs by life insurance companies and the like real money accounts have suddenly seen a need to do so. It's been brought about not really because of the data, but obviously there was that narrative or the report that any trade deal between Taiwan and the US would include a currency pact. Now that was being pushed back on, but it still lingers very much in the air, and I think there's still a lot of fear money looking to cover. The 1 year NDF currently is actually inverted to the spot price now. That might be the canary in the coal mine, which speaks to maybe further appreciation on the Taiwanese dollar. But if that was to somehow, come back into balance and correct a little bit, that might bring some sort of reduction in volatility in the market. But for now, I think markets, those life insurance companies are so under-hedged, they may well be entering the NDF market to maybe mitigate some of those losses. They'd probably have to disclose those to the authority when they sit down with them. But then you've had the situation exacerbated by hedge funds who can see blood in the water and will pursue this through the end to the end game. And for those funds that don't trade expressly into Taiwan or Malaysia or any of the other NDF Asia currencies, we're seeing demand for Aussie as sort of like a dirty proxy, as you will. It does provide the liquidity and the access, unlike the Taiwanese dollar, which is still, there were a few reasons, why it extended like it did, but how much blame you want to attribute to each thing. There were holidays in London and everything yesterday, but this time tomorrow, everybody will be back on deck, and we might see improved liquidity, which might see the rate of change in the currency maybe decrease just a little bit.
Are we going to see a similar dynamic when we see the mainland markets open, and what will be the implications given that the yuan is more of an anchor currency for the rest of the region?
Well, I think that the Asia's investors are really looking at the yuan for guidance. We're coming up to some clustered highs. I think just around 722, and psychological is 720. If we get through there, then that will be, like a tacit endorsement, by central bank, by PBOC to maybe let the thing appreciate. They're not sitting down talking currencies, they're talking trade tariffs, at the moment between the United States and China. So, the Chinese authorities will, not dance to any sort of tune from the US. If they want to let it run a little bit, they might. But there is the big picture, which I think the more pressing concern is that the tariff discussion. So neither the Taiwanese central bank or PBOC would want to see too much appreciation, because it does complicate a already complicated backdrop. So the fixing for the fixing today will be important.
Bloomberg's Michael Wilson there with the latest gyrations in the currency markets. Right, and we have also the latest from the corporate front. OpenAI is backtracking on plans to become a more conventional for-profit company. That's after facing pressure from former employees, academics, and rivals, including Elon Musk. The ChatGPT maker says it will still restructure its for-profit division as a public benefit corporation, but the overall business will remain under the control of its nonprofit. JP Morgan is set to lead about $6.5 billion in debt financing to support 3G Capital's purchase of footwear maker Skechers. A source says the debt sale is expected to launch later this month. Skechers shares soared on news of the deal, with 3G saying it expects the $9.4 billion buyout to close during the third quarter. China's top EV battery maker CATL is starting to gauge investor interest for its Hong Kong listing. That's according to deal terms seen by Bloomberg News. Bank of America Securities, CICC, China Securities, and JP Morgan are joint sponsors. CATL's listing could raise at least $5 billion, potentially making it the world's biggest this year.
Coming up next, we unpack how the election outcome in Australia affects the outlook for the global energy transition. This is Bloomberg. The Australian government's resounding election win at the weekend came with promises to tackle a housing crisis that's made the nation's property some of the most expensive in the world. Prime Minister Anthony Albanese says he'll ease borrowing rules and build 100,000 new homes for first-time buyers. But many economists remain sceptical of any quick fix to what is a complex problem.
It's a crisis years in the making. Nationwide home prices in Australia are higher than ever. Rents are at record levels and homelessness is rising. In Sydney, the average home costs almost 14 times the annual disposable income, making it the world's second most expensive city to buy property after Hong Kong. It's not just the biggest city that's expensive. Home prices in Brisbane, Adelaide and Perth have surged between 70 and 75% over the past 5 years to reach record levels. Prices have climbed so much that it now takes the average Australian buyer around 10 years to save a 20% deposit for a medium-priced home, double what it was in 2010. The single biggest reason for the affordability crisis is that Australia hasn't been building enough homes to keep pace with its population increase. Record levels of immigration since borders reopened after COVID have laid bare the poor supply of housing. Pressures include overly complex and slow approval systems, a shortage of building materials and labour, and opposition to development by local residents, known as NIMBYism, which stands for Not in My Backyard. Economists say that two controversial tax settings making it very attractive for investors to buy property are also fueling prices.
The government sets the rules of the game. And the problem in Australia is that the rules of the game have not been properly set and they've been based entirely on profit rather than balanced with the needs of people. That's the fundamental problem.
Having secured a landslide re-election, the Labor Party has promised 5% deposits for all first home buyers, 100,000 new properties at a cost of $10 billion Australian dollars for first homeowners. It's also targeting to build 1.2 million homes by the end of this decade.
A lot of mortgage holders and renters voted for the Labor Party, so that could definitely embolden them to go forth with trying to actually achieve more of those plans around increasing supply, which is really sort of key from here if we're to see more sustainable growth in home prices in the next 5 to 10 years.
Well, Albanese's win in Australia follows Mark Carney's election victory in Canada, and their leadership could result in stronger climate policy from these major energy exporters at a time when the US retreats on its climate commitments. Bloomberg NEF, for one, sees Albanese's victory as a win for Australia's decarbonisation trajectory. Let's get more from our managing editor for Green and ESG, David Stringer. David, it's interesting, right, because climate, energy transition, green issues sort of took a back seat in this election campaign that was very much driven by cost of living. What impact do we see in terms of this strengthened mandate over the weekend for the Labor Party and the impact on more decisive climate action?
Well, Heidi, as you said, this really was quite unusual and not typical of recent Australian elections that we've seen over the past decade, 2 decades, where those issues about energy, about climate change had been at the forefront. This time it wasn't the case. As you've just discussed, issues like housing and the economy were much more prevalent. Of the very few new climate policies that we did see the incumbent Labor government announce, they've committed to relatively modest idea, but roughly a sort of $1.4 billion scheme that would subsidize household batteries. So the idea there is to help extend and enhance the benefit that Australia gets from its record surge in rooftop solar additions. About the equivalent of 1 in every 3 rooftops in Australia has solar fitted. This idea would help supplement that. And what we are likely to see going forward is, new commitments and extension of some of the work Albanese's government has done so far on accelerating emissions cutting and also establishing things like a new national level environmental regulator.
When it comes to Australia hosting the COP31 global climate talks in 2026, does Albanese's strong victory strengthen the case?
Well, look, absolutely. And really, the prospects of hosting that UN climate summit, that would take place in November of 2026. That, again, was one of the very few things on the climate front that Albanese did talk about on the campaign. He used a campaign visit to the city of Adelaide in South Australia to put forward that location as his preferred host city. What we know is the opposition leader, Peter Dutton, had questioned the value of Australia hosting those showpiece climate talks that, attract tens of thousands of delegates to the host city. Albanese will now go push ahead. It's a bid that's being made in conjunction with Pacific nations, and that, of course, has two advantages. One, it showcases Australia's climate credentials, but it's also a diplomatic tool. It can help Australia as it looks to counter China's influence in the Pacific.
David Stringer there, managing editor for Green and ESG. We continue to watch the gyrations in the currency space. The Japanese yen trading within a narrow range, but after the strength we saw on the back of dollar weakness, 143 is the level, as the offshore yuan is also trading near the highest levels in almost 6 months. Mainland markets coming back from holidays, so do watch out for the yuan, which could really give us some signals about where other currencies are going, like the Korean won, which is very sensitive to the Chinese renminbi. Of course, Korea still away on holidays today, same with Japan, but we'll be watching the open in Taiwan after we saw that jump by the most since the 1980s. That currency strength across Asia right now as the dollar continues to weaken. The market opens in Sydney is next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. And Shery, we're seeing that sense of sort of impatience from these markets, right? Some jitters as we head into that Fed decision as well. But certainly with Trump teasing that potentially we see trade deals finalised and announced as early as this week, the market is set up for these expectations at a time where we're still seeing a great deal of uncertainty in terms of what's going on with negotiations, whether even these conversations are taking place with Beijing.
And it's really interesting to see that shift in narrative also away from U.S.-based assets, right? We're talking about perhaps the fading in concerns about U.S. exceptionalism. Secretary Scott Bessent saying that still the United States is a premier destination of global capital. But of course, we have seen the weakness of the dollar and the rally of Asian currencies.
Yeah, I love that comment that we heard from Apollo Global's Mark Rowan saying we've gone from hyper-exceptionalism for the US to just merely exceptional, right? That's a really great way to sort of characterise what we're seeing. This is also what we're seeing as we get into the start of trading here in Australia. Of course, we had quite a bit of holidays going into today's session around the region, but a number of key markets, including Hong Kong as well as China, coming back online after the May Day holiday. Pretty muted start to the cash session as we get that staggered session underway. We did hear some sentiment from the Macquarie CEO saying that she sees resilience in the Australian economy despite these ongoing tariff uncertainties. Watching, of course, Asian currencies, we've seen quite a good ride when it comes to the Aussie dollar, particularly in light of the resoundingly confident election result that we had over the weekend. At the moment, a little bit on the back foot there, I should say. Also watching treasuries as it is, of course, a Fed week, but we have seen Australian bonds seeing some of that weakness after the election, just falling in line with what we saw in that session with US Treasuries as well.
Yeah, we'll be watching the market reopens in mainland China and what the direction of the yuan is, given that, of course, it acts as an anchor currency around the region. And we've already seen that surge in the Taiwan dollar. Our next guest still sees opportunities in Asia, despite the volatility coming from really all of the durations around these trade tensions and tariff negotiations. Let's bring in Suresh, Tantia, APAC strategist and CIO at UBS Global Wealth Management. Suresh, great to have you with us. That optimism over potential trade deals really sending Asian currencies higher. You like still Taiwanese equities, but if you have a surge in the Taiwan dollar, will that make this very trade-dependent economy less appealing?
Absolutely. I think in the short term, there is going to be some impact on the companies in Taiwan, given the surge in Taiwan dollar. But keep in mind that most of these companies, they have strong pricing power. There is no competition for these companies in the world, especially in the semiconductor space. So I won't be surprised if these companies are able to have their way, manage the prices, and offset the impact of the currency strength. The other thing to keep in mind is that the result from the tech companies in the US is of any guide. The capex on AI is only going to accelerate. We are looking at AI capex from big four companies in the tech space in US increasing by 50% this year and 30% next year. And that would mean strong earnings potential for the tech names in Taiwan. So despite short-term volatility, I think the outlook for the equity market in Taiwan looks quite promising.
Given the business environment that you mentioned in the United States, does that mean that you still like that market? Because right now what we're seeing is the pressure on the U.S. dollar, pressure on U.S. assets because of this sell America narrative.
Yeah, I think the outlook for U.S. equity market is still positive, especially if you look at the recent economic data. The jobs report last week and the ISM numbers last night point towards healthy economy. We are not looking at a recession scenario in U.S. And healthy economic growth is good for an earning perspective. This quarter, earnings have been so far much better than market expectations. We are looking at 9% EPS growth for the first quarter compared to earlier expectations of 5% EPS growth. So I think a combination of strong earnings and healthy economy can drive the equity market higher. And from an index perspective, I think it's quite possible that S&P goes higher to 5,800 from current levels.
How do you feel about emerging markets at the moment, particularly markets like India?
Yeah, so apart from Taiwan, India is one of our other favorite markets within EM. The region being, it's more a domestic-oriented economy. So far, the growth was struggling, but I think it has bottomed out, especially as the capex deployment from government is coming in. The consumer demand is also picking up as Reserve Bank of India is cutting rates again. So I think a combination of that should support the earnings growth for the Indian equity market. And if you look at the EPS growth, this year India should deliver close to 15% growth, which would place it as one of the highest earnings growth market in the world. So these factors should support higher equity prices in India.
What about, obviously China remains a strong anchor, and you talk about some of the domestic stories in India. There are domestic reasons why Chinese equities might be compelling too, right? Or do you see that as too direct an exposure to the trade and US-related risks?
Yeah, I think in the short term, the Chinese equity market could remain volatile because we still need to see both sides coming to the table and start the negotiation. But from a long-term perspective, the Chinese tech stocks, the EV story, look very promising. For the last few years, the Chinese tech stocks have been under pressure because of regulations at home and at overseas. But finally, that era is ending. We are seeing government is more friendly to these companies, to the private sector. And with the end of regulations, finally, the sales growth, the earnings growth for the tech names in China is improving. So from a long-term perspective, I think the tech name looks very promising. Short-term, definitely, it depends on the trade negotiations. I think quite possible that with the messaging coming from authorities on Friday, the trade negotiations start soon.
Yeah, I mean, we still have to watch how those negotiations go, right? But Suresh, just looking at the currencies right now, especially in these smaller, more trade-dependent economies, we are seeing the Thai baht, the ringgit as well, at the strongest level since October 2024. Not to mention, of course, the Philippine peso also at the strongest level since March of 2024. The weakness of the U.S. dollar, you mentioned how Taiwan, at least when it comes to the likes of these big tech names, could still fuel the equities boost in this market. What happens to smaller markets, say Malaysia, Thailand, Philippines, just Southeast Asia?
In the short term, what we have seen in the past is that whenever Asian currencies strengthen, normally you tend to see capital inflows in this part of the world. And the equity market in Asia, they tend to actually outperform the rest of the world. So I would expect this happening. But from a longer term perspective, definitely a stronger currency is not good from an economic point of view, because that would mean it would impact the earnings of the exporters. So it depends on what kind of move we see. If we see a move similar to what we have seen in Taiwan, 10-15%, definitely there would be some economic damage as the earnings of the exporters will come into effect. But anything single digit, I think companies can manage, and equity markets should do well.
We've seen a 26% surge for gold this year, right? Do you think we have peaked, or do you think the trade uncertainties continue to see that relevance in the market?
I don't think this is the end of the bull run in gold, because the geopolitical tensions are going to stay with us for the next 4 years. It depends on the commentary that we get from U.S. administration. It's quite possible that there is a change of mind, and that lead to further tensions and escalation on the trade front. And that could lead to further demand from central banks around the world for gold. Also keep in mind that gold tends to do well whenever Fed is cutting rate. We still expect Fed to cut rate by 75 to 100 basis point by the end of this year. And that would only increase the demand for gold. So we still see this pullback as a buying opportunity, and expecting gold prices to go up to 3,500 by the end of this year.
Suresh, Tantia, APAC strategist and CEO at UBS Global Wealth Management. Really great to have you with us. More ahead on the Asia trade. This is Bloomberg.
America is the Schelling point of global finance. We have the world's reserve currency and the deepest and most liquid capital markets and the strongest property rights. For these reasons, the United States is the premier destination for international capital, and the administration's goal is to make it even more appealing for investors like you.
US Treasury Secretary Scott Bessent there speaking at the Milken Institute Global Conference. Well, Bessent's comments come as the Trump administration continues to tease trade deals that could shift investor sentiment again. Let's bring up Bloomberg senior editor Derek Wallbank. So tease is kind of the crux here, right? We've heard that we could see deals being announced this week, next week. I guess two parts, a very open timeline, but also how do you characterize these deals as such?
Well, Heidi, thanks for having me. I think, look, your first thing that you're looking for is who's first and what does first mean, right? And I think that's a real part of uncertainty that we're seeing right now. We've certainly seen countries like Japan come to the front of the table. Israel would be one that would be at the front of the table. Netanyahu met in person with Donald Trump about trade. And any one of those, South Korea could be one, India certainly could be one. Any of those where you're talking about a favorable relationship, somebody who gets along well with Donald Trump, he wants to make a deal. The first one of those that we see, we're really going to get a sense of both what it takes to get a deal as well as what that deal looks like. Now, I would not be looking for something that is hugely technical here. I'm not looking for something that's maybe going to be a Senate confirmed, trade package or something that Congress has to approve. That's not really what we're talking about. What we're talking about is a handshake deal. We're going to buy more of this. We're going to do this. This is our intention.
Sector-specific, right?
Yeah, and really like intention-based rather than necessarily something that is completely in the weeds. So that's what I would be thinking about here. Relationships, sentiment, those things are some of the things that I would be looking for. And yeah, you're totally right to mention the very first one of these. When you get that path forward is really going to be, I think, a lift for the market to say, okay, this is how that's going to go forward. Maybe this is going to give us a little bit more certainty in terms of what the pathway is going forward.
That pathway, very difficult to see when it comes to China, right, Derek? I mean, there has been a little bit of optimism that China may be signaling that they're open to start negotiations, but at the same time, they keep insisting that they want the United States to be, quote, sincere, to show sincerity. But what does that actually mean in terms of what do you get to them in order to get these negotiations going?
Well, look, you can almost put this into two camps, can't you? One of them is what is the pathway for de-escalation, and the second is what is the pathway for an actual deal. Those are two separate pathways, perhaps, maybe two separate roads entirely, to continue that analogy. The pathway for de-escalation looks like one that we may be seeing the initial stages of. You know, Trump has said that the tariffs on China, where they currently stand, maybe isn't where they're going to be full time. You know, they've put some signals that maybe there are ways that could remove. I'm not sure that the U.S. is looking to do that unilaterally. Maybe they will want something that is an offset that Trump can sell as a win, so it's not just that he's backing down by himself. At the same point, China has been very, very clear that it wants to be treated, I think the way that they have phrased it is with some more respect, you know, as a condition for doing some of the talks that could lead to a fuller U.S.-China trade deal. Look, make no mistake, China is the #1 nation that has been in focus of Donald Trump's tariff agenda. The #1 nation, and there's no one in second place. And so this is a big China focus. Getting a big deal there is going to be harder, you would think, than most of the rest of the nations in the world. So the first question that we have is really where that de-escalation path is going to go. That then lays the groundwork for being able to go into some of the actual big deal negotiations.
We've seen the Trump threat, the tariff threat, as a major factor in some of these elections, right? Incumbent governments getting re-elected, Singapore to some extent, Australia as well as Canada. How much is that playing in terms of the strength of both allies and competitors dealing with Trump, and how much domestic opposition is he feeling at the moment?
Well, I think certainly you've seen a flight to safety across the elections in Australia, in Canada, and in Singapore. In Singapore, the PAP, never really a question about whether or not they were going to lose. They've been in power since independence, but the vote margin goes up, as it tends to do in Singapore when there is a feeling of global instability. Certainly in Australia and in Canada, you are talking about two incumbent governments re-elected after having been in a very different position in the polls just a couple of months ago. And Trump's policies, his demeanor, the way that he's gone about things has certainly played a role in that, both on that side as well as in opposition leaders who had taken on some of his affectations and really not been, it didn't go very well for them in the campaigns. So that certainly is something there. I think that realistically, when you're talking about pulling this into a U.S. domestic scenario, Democrats in the United States still have not figured out how they are going to go at Trump. They don't really have a playbook. They don't really have a lead messenger for all of this, and they're really not quite sure what to do. Maybe you see a situation like Canada's, like Australia's here, where people say, right, there's a playbook. There is a way that you can go forward, that you can run a contrast campaign, as Anthony Albanese did for the entire Australian election campaign, come out on top. Maybe there are some lessons there that Democrats may look to take in the United States.
Bloomberg Senior Editor Derek Borbank there. More ahead on the Asia trade. This is Bloomberg.
We'll be watching the reopen of the mainland Chinese markets. Of course, we have seen strength in the offshore yuan at the highest level around almost 6 months or so. We are expecting the onshore yuan to potentially play catch up given the gains that we have seen in the offshore. The spread between the two has reached really an extreme level, as you can see on that right chart. And we have seen that any sign of yuan strength usually means lots of moves for Asian currencies like the Korean won and the Thai baht. Historically, they show very strong sensitivity with the Chinese currency. And this sudden surge in the Taiwan dollar could also offer some lessons for the Chinese yuan. Of course, there's been a lot of speculation that authorities might allow the Taiwan dollar to appreciate given the ongoing trade negotiations with the U.S. That's really led to that Taiwan dollar surge. Any indication that the PBOC or authorities in China might allow for more flexibility in the yuan could, of course, lift the Chinese currency. Now, China's central bank chief has called on Japan and South Korea to work together against U.S. tariffs. PBOC Governor Pan Gongsheng was speaking in Milan at a meeting of the ASEAN Plus 3 grouping. Let's bring in our China correspondent Ming Min Lo in Hong Kong. Ming Min, of course, we're watching the market reopens. We're watching what the PBOC governor is saying. What was the key message here?
Yeah, essentially he's saying that economic uncertainty is rising and it's important to have regional unity to encourage stabilization of the economy. And this echoes what the Japanese Finance Minister Kato also said at the same event yesterday. And also, we also saw this joint statement by the ASEAN Plus 3 countries yesterday talking about how the rise of protectionism and the tariffs from the U.S. could lead to economic fragmentation and how all these countries must come together to uphold that multilateral trading system. So I think so far from the signals from all of these Asian countries, it seems like the U.S. has not been successful yet to drive a wedge between these Asian countries and China. We know preliminarily from the trade discussions between U.S. and Japan that Japan has also been pushing back against U.S. pressure to form this united front encircling China. And I think investors will take this as quite a positive, encouraging sign that at least for these Asian countries, the priority is still to maintain economic stability, even as we keep a close watch on all of these trade deals that countries like South Korea, Japan, Vietnam are trying to negotiate with the U.S. Of course, all eyes are on what some of these other smaller Southeast Asian countries might offer to the U.S. and whether any of these deals would undercut Chinese interests. But for now, the signaling here is stability above all else for these Asian countries.
We're also seeing the return today for China from a 5-day May Day holiday. Are we seeing many trends when it comes to the travel data?
Yeah, it's quite a complex picture, and I just want to peel back the layers a little bit because we have the travel data, which are very robust, showing about a 10% increase on year when it comes to overall rail passenger volume. You look at the retail catering data, that's up about 6.3% on year compared to the same period last year. But if you break down that data and you look at where we are seeing the biggest jump, they are in sectors like home appliance, cars, as well as electronics, and these are all the sectors that benefit from those consumption subsidies. So the question then is, without these subsidies, what consumption sentiment really looks like? And another clue is the box office data. That's where we see very, very weak data, about half of the box office numbers that we saw in last year's May Day holiday. In fact, the slowest growth since 2022. And remember, in 2022, Shanghai was in the midst of that 2 months lockdown during the May Day period. That was very, very low box office numbers. So a very mixed picture here. We also have very strong numbers, though, from the inbound tourism spending, up about 170%. That's thanks to the visa-free policy as well as the tax rebates for tourists. So some of these policy measures really helping to boost that tourism numbers. But again, per capita spending, we haven't got that number calculated yet. That will give us another hint of whether people are traveling more and also spending more, or are they holding back on their spending even as they go out to window shop.
Bloomberg's China correspondent Min Min Lo there. Take a look at some of the other stories that we're following this hour. And Bloomberg has learnt that India is proposing zero tariffs on steel, auto components and pharmaceuticals in its trade negotiations with the US. Sources say the condition would be applied on a reciprocal basis and only up to a certain quantity of imports. The two nations are prioritising certain sectors to strike a deal before the end of President Trump's 90-day pause on tit-for-tat tariffs. Pakistan is accusing India of almost entirely stopping the flow of water between the border between the two neighbours as tensions rise. A Pakistani official says water flow has been throttled almost 90% since Sunday, potentially cutting supply to farms. India suspended a water treaty last month after gunmen killed 26 people in Kashmir. Pakistan denies Indian claims of official involvement in that attack. The Trump administration has blocked Harvard University from new federal research grants. The move could affect over $1 billion annually, and the Ivy League school would need to enter negotiations with the administration to resume eligibility. Harvard has come under fire from President Trump and his allies, who accuse it and other elite universities of ideological bias.
Take a look at how European futures are trading at the moment. We're seeing some downside after European stocks notched the longest streak of gains since 2021. We're talking about 10 sessions of gains already. We are seeing, of course, the earnings season underway across Europe, and they came in significantly ahead of expectations. Earnings growth so far at around 3.8%, outpacing the pre-season estimates of around a 1.4% decline. You're seeing a little bit of downside pressure on the euro right now. We're seeing a little bit of a rebound on the Bloomberg Dollar Index. And remember, the Bloomberg Dollar Index has seen year-to-date losses of about 7%, which is the most since the index was made 20 years ago. Of course, we continue to talk about this pressure and questions over U.S. exceptionalism. We'll be watching the Taiwan dollar when it starts trading, of course, with that market opening later today. This is Bloomberg.
Take a look at what we're watching when it comes to these dislocations across Asia's currencies, right? Asia's currencies, I should say, really being driven by the decline in the dollar. We're seeing it really evident when it comes to the levels that we've seen in the Taiwan dollar experiencing its largest gain since 1988. We're also watching the offshore yuan reaching the highest level in about 6 months. Certainly some concern there when it comes to what we see with the yuan fixing becoming a bit of a dilemma for the PBOC in terms of how they choose to guide that fixing today. At the moment, we're seeing dollar China really offshore sitting a little bit higher than the last parity fixing. That was before the Golden Week holidays, and we know that trading and the fixing resumes again today. But that jolt is also being seen when it comes to the Hong Kong dollar as well, as authorities there saying continuing to sell a record amount of currency to defend the dollar peg. So purchasing those US dollars to try and defend that foreign exchange peg, adding to another 60.5 billion Hong Kong dollars there, really adding to the 56.1 billion Hong Kong dollars is spent on the greenback since Friday. So we're seeing that repeated intervention for Hong Kong. Meanwhile, Taiwan Central Bank is warning against speculation on foreign exchange markets, saying that market chatter is partially responsible for the local currency's 2 straight days of record appreciation. Governor Yang Qinglong says irresponsible comments can destabilise the market. Let's bring in Bloomberg senior reporter Ruth Carson. So what are we seeing in terms of this seemingly insatiable demand for the Taiwan dollar, which is an outlier even as we see that broader trend across Asian currencies?
Absolutely. It's almost unstoppable, isn't it, when you look at the charts and what the Taiwan dollar's been doing. Now, 5% intraday, the biggest surge since the 1980s. It's nothing to sniff at. And essentially, there are a couple of big factors really driving demand here. For the Taiwan dollar, exporters definitely at the forefront here, converting their dollar holdings into the local currency. Now, remember that Taiwan is also home to some of the biggest life insurers in Asia, and they are big holders of US dollar denominated debt, that's treasuries, as well as corporate bonds. Now, a lot of these investments, a big chunk of them are actually unhedged or partially hedged, which means that when the dollar dives, they are in a lot of pain here. So that in turn has also really driven hedging by these life insurers. And as a result of all of that, you see this cocktail of insatiable demand for Taiwan dollars in a very short space of time.
Does this mean that this rally has room to run?
Well, that's a great question, and it will depend on the exporters' appetites as well as life insurers. But look, by all intents and purposes, it's a huge market, and there's still that demand for hedging. Now, remember that, as I said, a lot of these insurers in particular are partially or zero hedged at all to US dollar exposure. And according to BNP, for example, that's about 67% of their portfolio on average, which means that if the dollar does fall, the US dollar falls, they're going to be incredibly vulnerable to losses here. So will we continue to see that wave of Taiwan dollar buying? Yeah, absolutely. I think we can see risks of that happening.
What does it mean for some of the other Asian currencies going ahead?
So essentially, the wave of Taiwan dollar buying has been so just incredibly strong in the past two sessions that it's boosted everything from the Malaysian ringgit to the Hong Kong dollar and peers like the offshore yuan. Now, could this continue? Absolutely. I know that the dollar is a bit bit today, but all this can turn on a dime if sentiment changes. There's a bit of a whiff of optimism around trade or whatever it might be. That wave of Asia currency buying is certainly having legs, and traders that I'm speaking to, fund managers that I'm speaking to are all incredibly interested in this space. And so, yes, definitely brace for more strength ahead.
Bloomberg senior reporter Ruth Carson there, as we'll also be watching the equity space because Ruth, of course, mentioned some of those exporters that could be feeling the pressure today. Let's bring in Asia equities reporter Winnie Su. Winnie, because when it comes to the Taiwanese market, we already had TSMC, for example, under pressure because of the strength of the Taiwan dollar. What are we expected to see this week?
Yeah, so right now the market is really trying to see what the impact of a stronger Taiwanese dollar mean for the Taiwanese stock market. And just yesterday, we saw two reports out from UBS and JP Morgan talking about the earnings impact. So with UBS saying that 1% of appreciation in the Taiwanese dollar is actually going to hurt earnings by about 3 to 8% for these Taiwanese companies, just because of how many exporters there are in Taiwan. And also JP Morgan coming out saying that the Taiwanese tech companies are actually going to suffer the most. Like you mentioned, Shery, TSMC, we heard that 1% of appreciation in the Taiwanese dollar can lead to them shaving 0.4 percentage points when it comes to the profit margin. So that area is taking a lot of hit right now. And we saw yesterday the Taiwanese stock market actually fell about 1%. So those are kind of the negative parts that we're seeing for the market. However, the foreign inflow actually remains quite strong. We saw 2 consecutive days of flowing foreign inflow, even in this strengthening of the Taiwanese dollar. So on Friday, the Taiwanese stock market actually rose because of such expectation. So the money coming back into Taiwan can be something positive for the overall strength of the Taiwanese market. But it's just the insurers that remain quite unhedged, and also the exporters that people are watching.
When it comes to the reopening in Hong Kong and China, what are you watching for?
Yeah, so it's unlikely to be a very exciting reopening session for Hong Kong and Chinese market just because the narratives around trade talks are still quite unclear right now. So we've got the latest from Trump saying that he doesn't have immediate plans to talk to China. However, last week we saw the sessions for Chinese stocks overall quite positive because risk appetite was coming back on optimism that there's going to be more talks between U.S. and China. So that latest move and comment kind of poured a bit of cold water on that sentiment. So we might see some profit taking when it comes to the Hong Kong and Chinese market. However, we just saw the holiday data from China remains quite strong. So the domestic appetite is still there. And when it comes to the CSI 300, again, we have the support from the national team. So that might still be supporting the domestic market. But Morgan Stanley just came out with a report yesterday talking about how the foreign inflows for Chinese stocks remain quite muted. And actually, we saw that monthly outflow from foreign inflows first time since in 2 months, after 2 months of inflows. So that outflow we're seeing suggests that the appetite from global funds remain quite muted for Chinese stocks at the moment. And they're actually also adding more underweights to Chinese stocks based on that report. So overall, the risk sentiment for Chinese stocks remain quite capped. And we really have to see if there's going to be more progress between U.S. and China.
Bloomberg's Winnie Sue there. Let's get you some of the market calls that we're following today. Wells Fargo Securities' Christopher Harvey isn't budging from his bullish projection that the S&P 500 index will end the year above 7,000. That is a 24% increase from the current level. Harvey told Bloomberg that he thinks the time of peak uncertainty has passed. And Bank of America says credit markets can expect support from the White House that will limit the extent of corporate bond spreads widening this year. The bank expects investment-grade spreads should stay range-bound between 90 and 130 basis points. The strategists there say in a note that peak tariff risks are likely behind us. Well, coming up, we take a look at Australia's housing crisis and discuss business sentiment as well after the resounding re-election of the Albanese government. The Australian Chamber of Commerce and Industry CEO Andrew McKellar joins us next. This is Bloomberg. Take a look at how Australian assets are trading, particularly when it comes to equities. We're about 40 minutes into the start of the cash session. Pretty muted, off by about 0.1% there. Aussie stocks really, in terms of sentiment or even sector direction, looking past that election result over the weekend, putting an end to that longest rally in 7 months, really shrugging off the sort of political implications, but still positively regarded by strategists as adding just more certainty when it comes to the broader backdrop. We saw, of course, financial stocks seeing a pretty big sell-off given it was the first day this week of financials and banks' earnings of the season. Westpac continuing to weigh there. The Aussie dollar off by just about 0.3% there. We have had a pretty good run when it comes to the Aussie, and of course quite a few dislocations of strength with Asian currencies in light of the declines that we continue to see for the greenback. Watching bonds there as well, of course, following what we've seen in treasuries as we head into that Fed decision. Well, the Australian government's resounding election win at the weekend comes with promises to tackle a housing crisis that's made the nation's property some of the most expensive in the world. Prime Minister Anthony Albanese says he'll ease borrowing rules and build 100,000 new homes for first-time buyers. But many economists remain sceptical of any quick fix to a complex problem.
It's a crisis years in the making. Nationwide home prices in Australia are higher than ever. Rents are at record levels and homelessness is rising. In Sydney, the average home costs almost 14 times the annual disposable income, making it the world's second most expensive city to buy property after Hong Kong. It's not just the biggest city that's expensive. Home prices in Brisbane, Adelaide and Perth have surged between 70 and 75% over the past 5 years to reach record levels. prices have climbed so much that it now takes the average Australian buyer around 10 years to save a 20% deposit for a medium-priced home, double what it was in 2010. The single biggest reason for the affordability crisis is that Australia hasn't been building enough homes to keep pace with its population increase. Record levels of immigration since borders reopened after COVID have laid bare the poor supply of housing. Pressures include overly complex and slow approval systems, a shortage of building materials and labour, and opposition to development by local residents, known as NIMBYism, which stands for Not in My Backyard. Economists say that two controversial tax settings making it very attractive for investors to buy property are also fueling prices.
The government sets the rules of the game. And the problem in Australia is that the rules of the game have not been properly set and have been based entirely on profit rather than balanced with the needs of people. That's the fundamental problem.
Having secured a landslide re-election, the Labor Party has promised 5% deposits for all first home buyers, 100,000 new properties at a cost of $10 billion Australian dollars for first homeowners. It's also targeting to build 1.2 million homes by the end of this decade.
A lot of mortgage holders and renters voted for the Labor Party, so that could definitely embolden them to go forth with trying to actually achieve more of those plans around increasing supply, which is really sort of key from here if we're to see more sustainable growth in home prices in the next 5 to 10 years.
There are also calls for policy reforms and improvements from the business community in light of the strengthened mandate for the Albanese government that we saw over the weekend. Let's bring our next guest to take a look at the outlook for Australian businesses. Andrew McKellar is the CEO of Australian Chamber of Commerce and Industry, the country's largest business network. And Andrew, great to have you with us today. And in a lot of ways, some of the struggles that we've seen across the property space in particular, productivity, efficiency, labour, some of the bottlenecks, are broad-based, some of the challenges faced by Australian businesses. With this sort of strong mandate that we see now in the election result, what are the policy priorities for you?
Well, hi, Haidi. Great to be with you. Look, I think from a business point of view, clearly the government has been returned. They're in a strong position within the parliament. They won't have a majority in the Senate, so that's going to be one of the sort of practical realities that's going to have to be dealt with. But business is looking now for an ambitious agenda. We've got significant challenges, imperatives if we want to boost productivity, which has been lagging in Australia now for a number of years. It's been going backwards in the past 12 months. So that's got to be right at the top of the agenda. We have to have a strategy to grow the pie. So I think that's something that business is really looking for. Obviously, the global economic and geopolitical situation, that is also something that's a very high priority for Australia. An open economy reliant on its trading position, not so much the direct impact that we've seen of tariff measures that have been proposed out of the US, but the risk of confrontation between the major economies, the US, China, tensions across the Atlantic and so on. All of those things are very important to us. So I think business working with government to position Australia to be in the best position, to cope with those challenges. Those are going to be right at the front of the dialogue between business and government in the coming weeks and months.
That uncertainty could still continue, right, regardless of what a sort of position of strength Australian negotiators come from. I do wonder, what sort of impact are you seeing amongst your members already in terms of the impact on sentiment, on confidence, on the willingness to make investment decisions?
Oh, look, there's undoubtedly some level of uncertainty there, given the, the gyrations that we've seen in policy coming out of the United States. I think from our point of view, we've had strong engagement with the government, even during the election period. We've had close contact, with the embassy in Washington, and they've been working overtime. So, look, I think from that point of view, business can be confident that the government are fully engaged on this issue. I think they will bring forward a number of proposals in the coming weeks and months, and business can work closely with them on that. But it is a challenge, and there are some risks there that need to be addressed. But I think beyond that, as they get down to business now in the new term, we are looking for them to take forward probably a more ambitious agenda than we've seen simply articulated during the election campaign. That was focused very much on domestic issues, cost of living issues, housing affordability issues, healthcare issues, and so on. The reform agenda, how we boost productivity, how we grow the pie, and the priorities for that's something I think business really wants to see some action on in the next 3 years.
In order to get there, what sort of tax or regulatory changes do you expect, and what would you like to see?
Well, I think that the first thing in that regard, fiscal discipline. There's been a lot of talk about, expenditures, what the net fiscal impact will be. There is a little bit of uncertainty on that from here. We saw during the recent weeks the downgrade in the economic outlook from the IMF. We've seen some chat in terms of the rating agencies and our global credit rating. So those issues are material issues, and I think business will be wanting to ensure that any risks in that space are worked to the minimum level. So I think the government's fiscal position will be something that it will need to be very disciplined on moving forward. If we want to have any hope of being able to undertake tax reform, reducing the tax burden in the next 3 years, that's something that we need to have a debate on. We need to have consideration on. It's something that hasn't really happened in Australia for nearly a quarter of a century. So, business is keen to get that debate going. It's not so clear how easy that will be in the political realm, but that is certainly something that needs to be grappled with as soon as possible.
Especially at a time when most countries are distracted by all of these ongoing trade challenges in the negotiations with the U.S., right? How important is it for your members, for Australia to be able to diversify its trade relationships?
Oh, look, that is important, and I think that's part of the strategy. Of course, in the past 5 or 6 years, we've had trade measures in place from China. That's our number one trading partner. We have seen those progressively removed over the past couple of years. That's been a positive thing. But I think Australian business, Australian exporters learnt from that experience that we can't put all our eggs in one basket. There has been a strong focus on opening up new trade deals in the past couple of years. India has been a key area of focus. The Middle East. So that's also being an area of focus. The United Kingdom, we've done an FTA with in the past couple of years, and now there's talk again that potentially negotiations with the EU could be put back into place. So I think that would be encouraging. If we're going to have those sorts of agreements, then they need to be substantive agreements. We need to address the substantive blockages. They can't be, an agreement in name only. They've got to deliver real benefits. But I think business fully, sees the value in expanding those horizons, looking at the markets that we can grow more strongly. And diversifying, where our trade is going to currently.
Andrew, really great to have you with us. Andrew McKellar, CEO at the Australian Chamber of Commerce and Industry. We have more on Australia Ahead every Tuesday at 11:40am if you're watching here in Sydney, 8:40am in Hong Kong. Plus, you can tune into the Bloomberg Australia podcast too, which delves into the biggest stories shaping the country's role in global business. You can find that on Apple, Spotify or Bloomberg.com. More ahead on the Asia trade. This is Bloomberg.
The latest from the corporate front, Ford shares fell in extended trading after it suspended full-year guidance and warned the Trump auto tariffs will take a toll on profit. The company says the levies would cost it about $1.5 billion in adjusted earnings before interest and taxes. Ford cites several factors in withdrawing its earlier forecast, including potential supply chain disruption tied to the trade war. Mattel also citing the Trump tariffs as it withdrew its forecast for return for sales growth this year. The company says it's pausing its full-year guidance due to the volatile macroeconomic situation. Mattel makes nearly 40% of its products in China, which Trump has hit with a 145% tariff. China's top EV battery maker CATL is starting to gauge investor interest for its Hong Kong listing. That's according to deal terms seen by Bloomberg News. BofA Securities, CICC, China Securities, and JP Morgan are joint sponsors. CATL's listing could raise at least $5 billion, potentially making it the world's biggest this year.
Yeah, some of those associated stocks, battery names will be in focus as we get that reopen across major markets in Hong Kong and China after the May Day holidays. This is the futures picture there. Pretty muted when it comes to S&P futures, of course, heading into a Fed decision as well as expectations of more details on these trade deals that are being teased by the Trump administration. Taiwan futures looking pretty meek there at the moment. That strength that we've seen in the Taiwan dollar is going to impact exporters to some extent. And FTSE 850 China futures last trading a little bit higher there. We will also be really watching, in addition to the return to trading for China, but also where we see the limitations for that yuan fixing as well. That is it for the Asia trade. The China show is next.